Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about CFLT. The definitive analytical focal point for Confluent Inc. is, of course, the transformative announcement of its $11 billion acquisition by International Business Machines IBM.
Right. And that announcement just fundamentally reset the entire analytical framework for Confluent. We saw an immediate, really sharp market reaction, a gap up of, approximately 29% on December 8th, 2025? This repriced the stock to reflect that $31 all-cash offer, which is a substantial 34% premium over the unaffected closing price of $23.14.
Absolutely. And that repricing leaves us with a hefty valuation, roughly 11 times Confluent's trailing 12-month revenue. So this is really the central issue we need to tackle. Is this high valuation and this, rapid repricing purely a validation of CFLT's strategic necessity for the emerging AI era? Or is it complicated by cynical pre-announcement trading activity and the significant integration risks that IBM now faces?
And I contend we have to focus on the market structure mechanics that preceded the deal and, the execution risks that follow.
And I'm going to argue that the price action is the direct validation of Confluent's unparalleled strategic value for the next decade of data infrastructure. I firmly believe the market priced CFLT efficiently because the company represents an essential strategic asset, particularly as we move past generative AI and into the era of agentic AI. The $31 offer is an unambiguous validation of the data in motion thesis. I mean, think about it. AI agents need continuous real-time context. They just can't function effectively on batch or stale data. Confluent's technology, built on Apache Kafka for streaming and leveraging Apache Flink for real-time stream processing, is the critical infrastructure providing that necessary low-latency data flow.
But why $31 specifically, or 11 times TTM revenue?
Because it reflects scarcity. By securing this platform, IBM doesn't just buy a product, it acquires the pipes necessary to feed its Watson X AI platform reliably. This massive premium is, I think, justified purely by technological necessity. It reinforces IBM's strategic position as the Switzerland of the hybrid cloud, offering essential, neutral data connectivity across all major hyperscalers, AWS, Azure, and Google Cloud, preventing vendor lock-in from massive enterprise customers. Look, this acquisition is about securing the AI-ready data future, and the price just reflects that urgency.
See, I come at this from a completely different angle. While I appreciate the strategic narrative you've laid out, I view that $31 premium through the, let's say, harsh lens of institutional opportunism and future regulatory uncertainty. We really can't just ignore the dark pool microstructure in the weeks leading up to December 8th.
Are you referring to the elevated short volume?
Exactly. We saw evidence of heavy off-exchange short volume accumulation. For instance, the short volume ratio spiked to an extremely high 55.59% on November 25th. This pattern strongly suggests that smart money, meaning, sophisticated institutional players, utilize these hidden off-exchange venues, dark pools, to accumulate massive blocks of shares at a discount before the news broke. This action effectively absorbed institutional buying pressure away from the public exchanges, suppressing the price and allowing insiders to build their position in the low 20s.
And what about the risks you mentioned?
Well, the regulatory risks are front and center. The announced 18-month closing timeline extending into mid-2026 is a flashing indicator of high regulatory scrutiny. This duration, combined with the all-cash offer, makes the resulting low annualized arbitrage return, roughly 2.8%, highly unattractive for retail capital. For a transaction with such a long lockup, that meager return suggests the market is pricing in the cost and risk of the protracted regulatory process, not just strategic validation. Let's deepen the discussion on the pre-announcement market signals, specifically focusing on how institutional players, manage the price. We saw significant off-exchange short volume activity. Take December 4th, for example, where we recorded 1,344,632 short shares. This was not random market activity. This was a mechanism of engineered price suppression.
Okay, so define that mechanism clearly for us. How exactly does short volume in a dark pool suppress the price?
Well, when a massive buyer, say a hedge fund, wants a block of 1 million shares without moving the public exchange price, they execute the trade in a dark pool. The counterparty, typically a market maker, will sell those shares short to the institutional buyer to fill the demand immediately. This process satisfies the massive buy order without that pressure ever hitting the public price discovery mechanisms. The market maker then quietly covers the short position later. By executing these block trades consistently in hidden venues, they prevented an organic run-up, allowing those institutional buyers to accumulate shares close to the unaffected $20 price range, maximizing their eventual profit when the $31 offer hit the wires.
I see why you characterize this as manufactured accumulation, and it's true that high off-exchange volume often facilitates institutional entry. But I would argue that framing it purely as price suppression fundamentally misunderstands the dual nature of informed trading signals leading up to the announcement.
How so?
Because that accumulation in the dark pool was happening concurrently with equally aggressive and informed positioning in the lit options market. We saw a notable and frankly disproportionate surge in volume for out-of-the-money calls, specifically targeting the $28 strikes for December 19th. This wasn't just retail gambling. This was informed money taking leveraged positions.
And what does that options flow tell you that the dark pool flow does not?
Market makers who sold those OTM calls to speculators were immediately exposed to immense risk if the stock price spiked. That's their gamma exposure. To hedge this risk, they had to immediately buy the underlying stock, often in large quantities. This mandatory hedging activity contributed directly to the stock's steady, non-volatile drift upward from late November to December 5th. This confirmed the market's collective, informed expectation of a premium offer. So the confluence of silent accumulation and forced market maker buying via options hedging, to me, that signals market efficiency recognizing an inevitable transaction, not suppression.
I respect the complexity of that argument, but it overlooks a crucial point. Where did that options-driven hedging occur? The data suggests the majority of that hedging action, the buying you describe, also takes place in those same dark pools to minimize market impact. The dark pool didn't just facilitate institutional entry, it acted as a primary buffer, absorbing both fundamental accumulation and options-driven hedging interest without breaking that $20 to $23 price structure until the press release. The critical takeaway is that this coordination, hidden from public view, allowed sophisticated entities to maximize entry ahead of the $31 offer. It was market structure advantage exploited to perfection.
Even if we accept the dual nature of that dark pool activity, facilitating silent entry and executing hedges, it leads us back to the strategic core. I mean, why did institutions who are so sensitive to opportunity cost and risk aggressively accumulate at all?
They anticipated the premium, of course.
Precisely, and that anticipation validates the strategic scarcity. Let's shift our focus. I would frame the fundamental value differently when assessing the $11 billion price tag. The core technology, the seamless, real-time connectivity provided by Kafka and Flink, is just so vital that the acquisition is strategically bulletproof, securing the connective tissue necessary for next-generation AI and data architectures.
Bulletproof strategically, perhaps, but I'd say highly vulnerable operationally.
Wait, the valuation of 11 times TTM revenue is a reflection of scarcity. Competitors like Databricks and Snowflake were aggressively moving to dominate the stream processing layer. Confluence is the only established, best-of-breed enterprise platform dedicated purely to this data flow. It's a non-negotiable asset. IBM is the logical forever home for this asset because of its foundational commitment to the hybrid cloud model. Confluence operates neutrally across every major platform: AWS, Azure, Google Cloud. This alignment is perfect for IBM's strategy to prevent enterprise customers from being locked into a single hyperscaler, solidifying their position as an impartial intermediary.
I'm sorry, but I just don't buy that the strategic value is immune to severe execution risk. We have to weigh the strategic necessity against the post-acquisition integration reality. And let me tell you why I think that $11 billion is likely an overpayment.
Which risk specifically are you focusing on?
The pervasive blue wash anxiety. This is a common, often derogatory term in the tech and developer communities used to describe IBM's predictable integration strategy following a major acquisition. Users anticipate a debilitating cycle, product stagnation, mandatory integration into cumbersome internal IBM tools, and most critically, an engineering talent exodus due to IBM bureaucracy and, culture clash.
But isn't that a generalized, maybe anecdotal fear, rather than a quantifiable risk?
It is based on a clear historical pattern. When IBM acquires a developer-centric, innovative platform, which Confluence absolutely is, having built its reputation on open source Kafka, that innovative edge is often dulled by the integration process. Confluent's primary value lies not just in its software, but in its passionate, open source-focused developer community, adoption, and the talent base that drives it. If that talent walks out the door, or if the product roadmap stagnates, that $11 billion enterprise value has acquired a rapidly diminishing asset. That risk validates the decision of key insiders and institutions to sell immediately at $31, rather than wait 18 months for the close.
While the potential for talent churn is a valid consideration for any M&A deal of this size, the strategic imperative here, I think, overrides those integration risks. You mentioned competitors. Flink is rapidly becoming a key standard. If IBM had allowed a rival like Snowflake or Databricks to acquire Confluent, those rivals would gain an insurmountable edge in the data flow required for true enterprise AI adoption.
But you're arguing necessity dictates price, and I'm arguing that poor execution can ruin necessity. How will IBM manage the inevitable conflict between maintaining Confluent's open, multi-cloud neutrality and pushing their own IBM Cloud and internal software solutions onto the newly acquired customer base? That conflict is the engine of Blue Wash.
IBM understands they bought a neutral highway. Their success depends on keeping that highway operational for everyone, driving greater adoption and securing consulting contracts around it. The necessity to acquire and defend this asset, despite the high premium, dictates the price. The alternative, ceding the real-time data layer to a competitor, was simply unacceptable for their long-term AI strategy.
Let's pivot to the final point of contention, the external regulatory risks. I maintain that the closing timeline extending a massive 18 months into mid-2026 is an explicit, undeniable regulatory tax baked into the deal structure.
A tax reflecting delay, perhaps, but not necessarily blockage risk.
Oh, it indicates serious concern from powerful bodies like the U.S. Federal Trade Commission and the U.K. Competition and Markets Authority. They are going to investigate something called vertical theories of harm. This is highly technical, so let me clarify the practical implication. They will investigate whether IBM, once owning the critical Confluent data pipeline, will degrade Confluent's performance or quality of service when running on competitor clouds, specifically AWS or Azure, in an effort to unfairly force customers onto the IBM cloud.
That is a real concern, and it's why the closing timeline is long. They need time for regulatory review. But the key is that IBM has a strong legal defense based on its existing hybrid cloud model.
Maybe, but this serious regulatory scrutiny is directly priced into the duration. The risk-free rate for capital is currently much higher than it was a few years ago. Locking up capital for 18 months in an arbitrage trade, which is essentially what a long-term M&A deal is, for only a 2.8% annualized return is terrible for investors. It means your capital is inefficiently deployed, and that low return is the market's way of saying there is inherent duration risk here. The timeline is a major impediment.
I'm not convinced by that line of reasoning because the extremely tight gross arbitrage spread, the difference between the current price and the $31 offer, which is only 4.27% in gross terms, actually reflects the market's overwhelming confidence that the deal will not be blocked.
Explain the difference between delay and blockage as priced by the spread.
Okay, so if the market genuinely believed the FTC or CMA were likely to block this transaction outright, meaning the deal falls apart, the spread would be substantially wider, perhaps 15 or 20%, reflecting that high risk of capital loss. The tightness of the spread confirms that institutional capital sees this transaction as inevitable, only delayed by the necessary regulatory review process addressing those vertical harm concerns you raised. So while I concede the annualized return is poor for retail investors, the low blockage risk confirms the necessity of this vertical integration for IBM's ambitious AI and hybrid cloud plans. The strategic imperative just overrides the short-term financial inefficiency for long-term investors.
That assumes IBM can successfully navigate those regulatory hurdles without making concessions that dilute the asset's value. Any required behavioral remedies, such as a mandated assurance of non-degradation on competitor clouds, could severely limit IBM's ability to fully integrate Confluent into its own ecosystem, leaving them with an $11 billion asset that operates perpetually at arm's length.
That is a manageable integration challenge, not a blockage risk. And ultimately, that is what the $31 price tag buys: the certainty of control over the essential infrastructure, even if integration requires a careful touch. So in summarizing my position, the $31 acquisition price reflects the genuine scarcity and strategic necessity of Confluent's real-time data streaming technology for the emerging AI market. The price action in the preceding market signals, including that informed options flow, were a direct validation of this technological superiority and Confluent's essential neutral role in the hybrid cloud landscape. IBM's acquisition of this foundational data in motion platform is, I believe, strategically imperative and worth the high multiple.
And from my perspective, understanding this event requires a critical appreciation of the institutional accumulation that preceded the announcement, utilizing opaque market structures to suppress volatility and maximize entry, and the substantial risks that follow. The acquisition is significantly clouded by the 18-month regulatory road ahead, and the high probability of developer and customer backlash, the blue wash effect, which may diminish the asset's core value post-close. This suggests the $31 valuation may represent the absolute peak value extracted by institutional players rather than a reliable indicator of long-term strategic success for IBM.
So we've discussed the sharp market action, the strategic rationale driven by the AI connectivity thesis, the role of dark pool accumulation and options flow, and the nuanced investor sentiment regarding the 18-month regulatory road ahead.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.